Welcome back, chip stock investors. We've got something a little bit different for you today. Going to introduce a couple of newer companies to you that we haven't covered here before, little known names in the semiconductor space. And I'm going to do so using a trading technique often used in the short term by those trying to take advantage of mergers and acquisitions. A technique called merger arbitrage. So the companies in question right now are MaxLinear and Silicon Motion, ticker symbols MXL and SIMO. Covered these very briefly a couple of weeks ago in a short. Talked about them briefly a couple of weeks ago with Jose Najarro over on his podcast, Semiconductor Investing and More. Here's a quick take on what is going on between these two. In May of 2022, MaxLinear announced that it was going to be acquiring Silicon Motion. And this merger was going to be accomplished with a combination of cash that MaxLinear would raise via the issuance of new debt to investors, as well as a little bit of issuance of new stock. That way, Silicon Motion would get a stake in the newly combined business. So the offer that has been approved by Silicon Motion shareholders is for $93.54 per share of Silicon Motion in cash, plus 0.388 new MaxLinear stock for every share of Silicon Motion. So combined $93.54 plus 0.388 shares of MaxLinear. MaxLinear, as of this recording, trading for $34.80. That works out to roughly $13.50. So when you combine the cash and the partial share that will be swapped out for each share of Silicon Motion, in total you get $107 per share for Silicon Motion. Here's where the merger arbitrage opportunity comes in. Because if you look at Silicon Motion stock right now, it's only trading for just over $63 per share. This offer from MaxLinear is for 70% more value than where Silicon Motion is currently trading. So merger arbitrage is where an investor would buy shares of a company being targeted for buyout, and they collect the premium, the difference between where it trades now and what the ultimate buyout offer is. And in this case, if the acquisition were to close by the first half of 2023, like MaxLinear expects it to, that would be a 70% gain. In less than 6 months, I'd say that is a pretty hefty investment return. No one's going to complain about that. But this is really, really unusual. Usually when there is a merger or acquisition announced, the target company that is going to be acquired, its shares will tend to trade 5%, maybe in an extreme case, 10% less than the ultimate buyout offer. And as the date of that closing nears, that difference between the current price and the buyout offer narrows. Obviously, 70% is highly abnormal. Something is going on here. The market doesn't seem to think this is a high probability merger between MaxLinear and Silicon Motion. I believe the hangup here is political in nature. So MaxLinear is a California-based chip designer. Silicon Motion is based in Taiwan. So China has made it clear they want Taiwan to be reunified with mainland China, even making hints that perhaps an invasion would be on the table to do so at some point in the future. We're not going to talk about that. It's all speculation and not my specialty in speculating on. The US has put new chip export bans in place for US companies that sell into China. So I think there's a possibility of retaliation here. Chinese regulators are one of the regulatory bodies that have to sign off on mergers and acquisitions within the semiconductor industry, given that China is such a massive market for chips. And I have serious doubts that Chinese regulators are going to sign off on an American company acquiring a Taiwan company, pulling a chip designer out of Taiwan, and then potentially in the future having to deal with export ban restrictions. MaxLinear's CFO, Stephen Litchfield, said at a tech conference that they still think the acquisition will go through. Chinese regulators are taking about a year, sometimes a little bit less, sometimes a little bit more, to approve these things. So May 2023, just a few more months from now, is about when we should hear some news about this merger getting signed off on. But at this point, I would not buy Silicon Motion stock in the hopes that it gets acquired and you reap that big merger premium. So where does that leave us? I'm not going to cover Silicon Motion in this particular video. We'll do that one later. Silicon Motion designs controllers for NAND flash memory. The memory market is in a bit of turmoil right now. I think there are a lot of question marks there. But let's talk about MaxLinear. To do some rapid fire analysis here on business strengths and financial fundamentals for MaxLinear. You can see here on my ticker terminal, by certain metrics, MaxLinear stock looks absolutely cheap. Less than 9 times trailing 12-month earnings, less than 10 times free cash flow. The stock has been completely wiped out by the bear market in the last year. And you can see that came at a time that the company experienced some really, really fantastic growth over the last few years during the pandemic. Huge boost, almost 51% revenue gain in 2020, almost 90% up in 2021, and on track this year for mid 20% growth. So MaxLinear is basically a Broadcom competitor. We'll call it a mini Broadcom without the dividend, much smaller, no income from a dividend payment. Most of MaxLinear's revenue comes from internet infrastructure. They're getting into Wi-Fi as well, helping power Wi-Fi 6 equipment. Wi-Fi 6E rollout is now underway. They have a Wi-Fi 7 technology platform. So again, a lot of similarities here with Broadcom. This is primarily an infrastructure play. So Broadcom does have that sizable smartphone business. They supply Apple and other smartphone makers. MaxLinear here is more just infrastructure based, more consistent growth. Historically, before the last few years, not a ton of growth, but a consistent revenue generator here, decent profit margins. You can see again here in this just quick picture from the ticker terminal, net profit margins tend to be in the low 20% range. Expectations here that might increase to the high 20% range in the next couple of years, though there is an expectation that some of that growth starts to level off here in the next couple of years. This is an interesting business. I actually kind of hope that this acquisition of Silicon Motion doesn't go through, because the company would have to raise a significant amount of debt to do so. There would definitely be some operational benefits if they did take over Silicon Motion, but that may not happen. So I think for now, we don't need to discuss that. But I think the takeaway here is MaxLinear looks to be really, really cheap right now. I'm putting this one on my radar, and we'll do some more digging into it. They report earnings on February 1st, so look for some more updates at that time on MaxLinear. That's a wrap on this primer on MaxLinear's business, as well as what merger arbitrage is, and hopefully why not to do it in this particular instance. We want to hear from you. Put your comments below if you have any questions, if you have any insight on MaxLinear or the buyout offer made to Silicon Motion. And make sure you hit the subscribe button. Earnings season is coming later this month. We'll have tons of updates on companies in the computing technology universe. We'll see you all again real soon. Take care.